And good morning once again. And thank you once again for joining us here at our weekly life insurance webinar training sessions. Mark Contra at the Messer Financial offices just outside of Charlotte, North Carolina. And as I'm looking at my attendee list this morning, once again, I'm seeing all the names that are familiar, and thank you all again that you've taken the time out of your schedule. All these different dates, most of them have been on Wednesday, but we've had to make some adjustments due to scheduling. But it is the same group of people. You've been with us since the beginning, which is wonderful. As you know, we've really started with all the basics, from trying to find a client to the tools that were necessary. And during those presentations, we also had the benefit of having the same lady, Charlene Thardelson, that is with us today from North American, that gave you some tips and tools to use when we were working with our clients. And as we progressed through the sales process, we worked basically on the simplified term type of products, some of them with additional riders that were added in these most recent years to enhance the products in life insurance. We did a little bit of work on long-term care by use of life insurance also. We've done a little bit of work on simplified life. And so today it's only justifiable that we have the opportunity to indulge ourselves with the Index Universal Life products. And again, being very selective on my part of the carriers that we have worked with, because again, I want you as agents really to have the confidence and work with the carriers that I feel provide you with the best products available. And I truly feel that way working with North American and their index products. North American has been around with this game for almost 12 years, actually. So they have the experience in the past. They've also been what I consider a very fair player. And what I mean by that is when they work with their illustrations, they've not been one that's been out there with pie-in-the-sky predictions of what was going to happen that caused some people to have problems with the products that they purchased. So that confidence is why, again, I've chosen and ask you to take the time, if you haven't already, to get yourself appointed with North American, so you will have these products and all the benefits that they offer, which we'll touch again on later. With that in mind, then, once again, take this opportunity to welcome Charlene Thardelson. Good morning, Charlene.
Hi, Mark. Thank you. Thanks for inviting me back to be with you and the agents that we have with us today. I really appreciate the opportunity to represent North American and go over some information to further everyone's knowledge on the topic today on IUL. And we are going to start with some of the basics because sometimes, there are some people out there that are just a little overwhelmed or intimidated by the whole IUL name. And really, when we boil it down, there's not all that much to be afraid of. There's just so much upside potential and opportunity with it. But yet there's protection in place to keep your client from what we would think of, or what most people I think of, is that IUL is like they're putting their money in the market, and it's not. They're protected from all that downside risk. So that's what I want to be able to explain to you today, is show you that it's really not all that different than traditional UL in the way that there is an interest rate that's credited, but it's protection from the downside with all the upside potential. So we'll go through that. And then I'm going to touch on a little bit on the products as well. Like Mark said, North American has been in the IUL business for about 12 years. And each year we are gaining market share. We are one of the fastest growing life insurance companies. And that is pretty much primarily due to our strong IUL portfolio. So with that, let me go ahead and introduce you to the presentation that I've got here. We will, I think, Mark, you guys are probably all used to this, but do ask you to type your questions in, and we'll entertain those at the end. But I do have a lot of information to carry you through, and probably will be answering some of those just methodically through the presentation today. So feel free to take some notes, and like I said, prepare those questions so that if we don't address them through the presentation, we can get those for you at the end. So the agenda for today is to take you through the actual definition of IUL, just boil that down. And then I want to spend some time talking about some unique IUL features, and some of them that are unique to North American. All carriers are going to have some similar features when it comes to IUL. We have a few that are very unique and other carriers don't have, so I want to touch on that. And then I want to introduce you to North American's IUL products, which all have the word builder in the title because that's what an IUL product primarily can do, is build cash value. So starting with the definition, what is IUL? Well, indexed UL is similar to a universal life in that it has a guaranteed account, but it also has an indexed account. It has, the same death benefit coverage and has the same flexibility that a UL has, where it can be paid up in a shorter number of years. There's usually some flexibility to skip a premium based on what the account value is and maybe make that up later or pay it another time. But it's all similar to UL in that way, shape, or form, in that flexibility on premiums, paying it up over a 5, 10, 20 pay, paying it up at 65. But the difference is that IUL also has this indexed account. So it has a fixed account, and if somebody wanted to get an IUL product and have it run just like a UL product, then all they have to do is allocate their money to the fixed account. But what makes it different is these index accounts. And interest is credited to the index account based on the performance of a particular index. And we have over 10 different index options for the client to choose. So they can choose one and put 100% allocation to that, or they can choose two and they can do it 50-50 or 75-25. As long as however they allocate it, it comes up to 100%. And so then the interest rate is going to be credited based on how did that index perform over a period of time. So we have to identify what that period of time is, and I'm going to spend a little more time digging into that deeper for you, where we're going to introduce you to the terminology of an index bucket. But basically, if the index goes up during this period of time, then we're going to credit, measure and see what that interest amount would be, and we will credit that. If it goes down, well, then that's where they're protected by the floor. So the floor in an IUL product is going to be 0%. So if an index goes down and loses 5 or 10%, that's where the client is protected. They don't participate in that. Instead, we're gonna stop at the floor, which is 0, and there's not going to be anything credited that year. And so a 0% crediting versus a 5 or 10% loss is much better. So the important thing to remember about IUL is that the customer is never directly investing in the market, and that's the beauty of it. And that also, for you as an agent, makes it that you don't have to have the type of license for a product that is directly investing in the market. So let's look at this slide. I want to start on the left-hand side where it's the fixed UL. That's our traditional universal life product. So we've got the growth is at a stated interest rate. And so usually there's a guaranteed, but there might be a current rate that is being credited. The minimum rate is disclosed in the policy, but then the company declares the current rate, which is probably going to be a little higher than that guaranteed, but not by much. So I think we might be seeing those rates currently, maybe around, the guaranteed might be around 3, and the current might be 3.5 or 4% is what you might be seeing on a fixed account these days. And the last item there, non-registered, meaning that the agent, you, the agent who's selling that product, you don't have to be a registered rep to sell that product. So let's go to the far right where it's the variable UL. And this is a product that has been around for a while too, but the difference is the client actually participates in the market. And so that 5 or 10% loss that that they experience, that too would be reflected in their policy. So there's no minimum, there's no protection of, say, a floor like I just explained, and the client can actually use money. And then lastly, the agent does have to be a registered rep, licensed with a Series 6 to sell a variable UL. So that's where, if we look in the middle column, this is kind of a blend of the two, if you will, as far as where the IUL product comes from. So first being that the interest that's credited is based on the performance of an index without actually participating in the market. It's just like the measuring stick, the measurement tool that's used to determine what the interest rate will be, because we as a company are going to buy the index call options and such that are going to allow us to pass on that performance, that index performance to the client. And so the minimum rate of the 0% there, that's that floor that I'm talking about. And then non-registered, meaning you as the agent do not have to have a Series 6 license to sell this product. So let's talk about a little bit why would a client be interested in IUL instead of the other options. So let's first talk about a variable UL. A VUL can really get some good returns, maybe even higher than what a client could see in an IUL. But the major problem for the consumer with a VUL is that it's full participation in the downturns in the market. And variable UL actually invest in the market and get all the losses in the market is experienced by the client. And so this can really be a major concern for clients who want to make sure that their life insurance policy doesn't actually lose cash value. And especially, just like anytime that you're planning for your own retirement and any other retirement type vehicle, the closer that you get to retirement, the less risky you get. Well, that you really don't have that type of opportunity in the VUL. I mean, I suppose you can change your selections and such, but life insurance has a little different piece of the pie there, if you will, is that you also have life insurance in there. It's not just about the cash value. So you don't really want that to be losing and end up later with no life insurance policy because all the value was lost, or having to pay a much higher premium later. So on the opposite end of the spectrum, even though on my last chart I really was just talking about UL, but there could have been another column to the far left, which would have been whole life. And whole life really is going to be designed, I mean, this has been around for a while, but it's really designed with full guaranteed returns. So the client knows going right into that product what the guaranteed interest rate's going to be, and they usually can disclose what the values are going to be at different times in the future. But so the problem with a whole life is that it's also guaranteeing that you're not going to get the current rate and that extra upside potential. So since everything's locked in when you purchase a policy 20 years later, when interest rates are much higher, the client is not going to be able to experience that because they were guaranteed and locked in at a lower rate. So because of the conservative nature of a whole life policy, they can be typically more expensive than a fixed UL, IUL, or even a variable for that matter. So then let's talk a little bit about the fixed UL, the traditional universal life policy. This product has been proven effective middle ground between whole life and variable by having a conservative but not fixed interest rate, but yet then having a guarantee. Generally has been less expensive than whole life with significant cash value growth potential, and being safer than a variable as far as potential loss in assets in a negative market. But the main problem right now with a traditional UL is that low interest rate environment that we talked about that, might only be around 4% or such. So, so and we know that we have low interest rates even in savings accounts and CDs and such. We know and mortgage rates talk about how low they are. So we know there's a low interest rate environment out there, but if we can offer our clients something more with that upside, a higher interest rate, but then that protection of the floor, that's where IUL is really going to be beneficial for you and your client. All right, so let's go through some of these benefits of what it can mean to your client. So high growth potential. An IUL, when we sit down and design an IUL life insurance policy for your client, we can design it based on different parameters as far as their level of funding. It has the ability that they can overfund it and pay more than what's actually needed to carry the cost of insurance. Because when they see the return that they can get from the performance of the index, that can really grow their cash value into something more. And so they might want to have that opportunity to pay more into it versus putting that extra money into some other vehicle where it's getting minimal to nothing interest rates. So there are limits, of course. The IRS is going to set limits on how much can go into a life insurance policy, but we're going to have quite a range between what's minimally needed to cover the cost of insurance and then to what amount we can overfund it and have the cash value grow even more. And this might be a conversation that comes up when you are reviewing, say, an annual report with your client, and you're going to be able to show them, look at all the interest that you earned in this last year or 4 years or 5 years. And they see that, the light bulb kind of goes off and they're wondering, boy, could I put more money into this? Could I pay it up or put more money in and have it grow even larger? And they can, if we've designed it properly, if we've left enough room in there to increase the premiums. And then potentially lower premiums. So while we just talked about you could pay higher, you could overfund it, but you also could, because we're paying it up early or because cash value is growing, there might be an opportunity to stop premiums earlier or lower or skip it. So we're still going to have that flexibility in there. And if we compare an IUL product to maybe, it is a good exit strategy for somebody who's in a variable product and they've been seeing that they've been losing some money. So we might be able to lower their premiums by moving the 1035 money of what's left in that other VUL product into here. We could potentially lower their premiums and give them better cash value growth potential. And then there's a minimum interest rate that's guaranteed. So I know that I've mentioned that there's a floor of 0%, and then our cap on our S&P 500 is 12.5%. So there's a range really between 0 and 12.5 of what they could earn. But there's also, North American has a guarantee minimum that if the client hasn't at least averaged a certain return from their index performance over a period of time, that we're going to true it up to this guaranteed amount. And so for us right now, that's a 2.5% guarantee. And ours is over a 10-year period or any time that the policy is ending. And we'll probably spend a little bit more time on that when we talk about our IUL features a little bit later. So I'll go back to that guaranteed. And Mark, if you want to remind me too, if that doesn't come up on one of our slides, I'll make sure to go over that in a little bit more detail. So the markets, as far as what clients would be interested in an IUL product, well, first and foremost, it's life insurance. So anybody who has a need for life insurance, death benefit, anybody who's looking to have some sort of a flexibility on the face amount, the premium, having control over that product for the rest of their life and being able to make those changes. And then somebody who's really just looking for a good return without putting all of their money at risk. Some looking for that downside protection, but that upside growth potential. So really just about anybody out there. And when I introduced you to our products, we're going to talk about that there's one that even offers a guaranteed death benefit. So we can we'll talk about that product as well. So let's move into the features part of it, and we'll talk about some specific um, uh, items that make up an IUL product. So first of all, we talked about what makes it really different is that they're going to choose an index option. And so there is a variety, over 10 different options that they can choose from. And then as far as the different types of crediting, again, they're not investing directly into the market. They're just choosing, kind of placing their bets. Which one do they want to be measured for their index return? So things that are going to sound familiar to them, S&P 500, the NASDAQ, and then, of course, there's a fixed account that they can choose. And once money is allocated to an index account, it does have to stay there for a 1-year period of time. That's the point in time that we're going to watch, if you will, the race of the index that they chose to see how does it fare. So then at the end of the 1-year period, that's when we'll measure it grew by 5%, it grew by 10%, or maybe there was a loss. That's when the race ends and we determine what kind of growth there was. But after that 1-year period, if they want to reallocate it to a different index option, they can. Money that goes into the fixed account can be moved out of there at any time. So maybe they put money in the fixed account now and 3 months later they want to move it out, they can. Money in the fixed account is credited on a monthly basis, so it doesn't have to stay in there for a whole year. So let's talk about how this index measurement period works. A lot of companies you'll hear when they talk about IUL, they're going to talk about buckets. As far as every time a premium payment is paid, we put that money in a bucket and we put the date on it, or an envelope, if you will. But we label it there, and then we're not going to look back in that bucket until a year from now to see how did the index perform. And so if somebody's just paying annually, you can see that the money's going to go in the bucket, and we're going to have a label on it that says September 6th. And then when they pay again next year, the payment may or may not get to North American on the 6th, or it might be a weekend. So the payment might come in on September 8th. So we might, even though they have annual payments, we still might end up with different buckets, because sometimes it'll come in early, sometimes late, depending on where it falls on the weekend and the holiday. And then if somebody were paying monthly and it was due on the 6th of every month, and even though it might be a monthly bank draft, there's still going to be some fluctuation for weekends and holidays there. So we might have a September 6th, and then an October 7th, and then a November 6th. And every time money goes in, again, now that has a label on it with that date, and we don't look at it again for another year. So on this next page here, I've got an example of somebody that pays the premium twice a year, so a semi-annual premium payment, just to give you an idea of how this might look. So let's say the first bucket starts on January 1st, which technically that's probably a bad example because that'd be a holiday. But just for an example here, January 1st, the money would go into the bucket, and then we would look at it again on January 1st of the next year. And what we're doing is we're measuring whatever index option they chose, which in this one we're going to use an S&P. The value, not their premium, but the index itself had a value of 1,000. A year later, the value on the S&P index had grown to 1,100. So that represents a 10% growth. So now whatever money was in that bucket, whatever the client had paid as a premium, could have been $500, could have been $10,000. Whatever money got put into that bucket with the January 1st date on it is now going to be able to be credited that interest rate. Now there's some adjustments that are made, such as a premium load that has to come out of there, and we'll talk about that again in a future slide here. But that's what we're measuring, is how much did the index grow over that period of time to determine what index we're going to credit, or what interest rate, which is 10%. So then their second premium comes in halfway through the year, halfway through the index growing from 1,000 to 1,100. And so it comes in when the value of the index is at 1,050. So it goes into the bucket labeled 6/1 and 1,050. And a year later, on 6/1/2017, it maybe grew higher than the 1,100 up here on January 1st, from January 1st to June 1st, and maybe came down some, maybe went up higher. But on June 1st, when it ended at 1102.50, which represents a 5% growth. So you can see that now there was one payment that is getting credited 10%, and a second payment is getting credited something less because of the 1 year period that money was where we were looking at the S&P. So each premium payment can have a different index credit. Even though they're both in the same S&P, the starting and ending dates for the measurement were different. So there's a couple different crediting methods that are available on some of our index options. And so the first one here that I want to talk about is the point-to-point. And kind of what we've already been talking about. So it measures the growth from point A to point B, which was our 1 year period, which was January 1st to January 1st. And then it's going to be subject to a cap rate, which I had mentioned, 12.5%, and then a participation rate. Most participation rates are at 100%, but they can be higher or lower, and we're going to take a look at some of those. There's also an averaging. At this one, a crediting method of averaging will average the index values for that period. So say we had let's go monthly averaging for a second. It's going to compare where did it begin on January 1st, and then compared to where it was on February 1st, and then it marks down what that growth is. And then it does it again from January 1st to February or to March 1st and measures that. But then at the end of the 12 months, it takes all of those 12-month periods and measures that and gives it an average. So it's not taking all of the day, or it is taking more of the days, but then it's looking at it on a monthly basis. And then daily averaging would be every single trading day compared to where it started, and then again averaging that out. That gets a little bit more complex. You can see in the previous example that we went through is really, it didn't matter how many times the index went up or down from January to January. It just mattered where was it on January 1st of 2016 and where did it end on January 1st of 2017. So a basic equation here, picture equation, if you will, of how the index crediting works is we determine, where did it start and where did it end? And we determine what interest rate that is, and that's our 10% or a 5%. Then we look at what's the participation rate. I talked about that most of the time it's 100%, depending on how the index option is designed. So if we're taking 10% times 100%, then that's still 10%. But then we have to look at, is there a cap on it? Like I had just mentioned, I was using a 12.5% cap. So since our 10% is lower than our cap of 12%, we're okay. We're not going to have to make any adjustments. If our cap would have been 9% and we got a 10% return, well then we wouldn't be able to credit the full 10%. We'd bring it down to the cap. So a couple more examples to show you on this to bring it all together, and then we're going to move into more of North American's products. So the cap is our ceiling, the floor is our zero, so we're somewhere between that 0 and that 12.5%. And then annual reset means this is probably more important when there's been a loss. So if we started on January 1st at one value and the next January it had actually experienced a loss, what it means is that next year we just go to where it ended and we're just looking for growth from that point forward. We don't have to regain all that was lost in that last year before we start crediting an interest rate. What it means is, all right, there was a loss last year, but guess what? Move your move your bucket to this point, and now we've got it 1 year later, January 1st, 2017, and we put the measurement stick here, and we're just looking for growth from this point forward. We don't have to regain all that was lost before we're in the positive again. That's what the annual reset means. So I'm going to get, I think, I'm going to get a highlighter here just so that I can show you through this slide, and we'll walk through a few examples. This is kind of what we've already gone through on the previous slide, this first one. So over the 1 year period, the index grew by 7%. The index selection they have is at 100%, so that gives us a crediting rate of 7. Then we come and look to see if our 7% is in between our floor of 0 and our cap of, in this example, 13. It's right in the middle. So the crediting rate that we're going to be able to apply to the client, to the customer's index account is 7%. Here's an example, this next one, where the index growth was higher. It's 16%. We're still at 100. That gives us 16. And now we look at 16%. It actually happens to be above our cap. So now we have to apply the cap, and that's what you'll see gets carried over here, and that's what the client actually gets credited. Let's go down to the last one here for a second before I come up to the third one. Here's a loss. The index was down 11%, times 100%, that's still negative. But negative falls on this side of our floor. So this is the protection. This is the floor of 0 coming into play, and that's what's going to get credited or not credited. But it's a heck of a lot better than having 11% taken off. So that's how that works. So we're always looking at the cap and the floor after we determine what the crediting rate is from the index growth and the participation rate. Now this third one here that I want to go through, this would be, we have a lower participation rate because this one does not have a cap. So usually you see a lower participation rate when there's no cap. So the index grew by the largest number, which is 18%, and now we apply 55% of that, which gives us 9.9. And the only thing we have to be concerned about is our floor of 0. And we're above that. There's no cap that applies, so we can apply the full 9.9%. You can see that if this was a 40% growth times 55%, you'd see we'd get, definitely double digits over here. So a lower participation rate usually goes hand in hand with that there's no cap. All right, so that's a nice scribbly mess there. Let me go ahead and get rid of that for you. All right. So just a few examples, just applying some simple math. The great thing is that you and your client don't have to do this. North American handles it all for you. It'll be displayed on the annual report. But it does give the client something to follow if they want, because it's so simple. What was the index value on the day I paid my premium, and what is it 1 year from now? So it is something easy to follow along. All right, so I want to introduce you to North American's IUL products, which I had mentioned earlier have builder in the name because they are going to build cash value. So our core product is our builder IUL. Our guaranteed builder is one that this would be most similar to a whole life product. So we can determine what's the premium needed to guarantee the death benefit, and then the death benefit will be in place, and then no matter what, it'll be guaranteed. But guess what? If the index performs well over those years, there could be significant cash value, and there's the ability to pay more premium in to help increase that cash value. But we can determine what the minimum premium is to guarantee that coverage. The rapid builder, in its name, the word rapid means that it builds cash more quickly. So if the client really needs to access the cash in a short period of time, 5 or 10 years, they can put their money in and they'll have greater growth in those early years than the other product. But overall, the builder is going to be the best product for long-term performance and for it's a product I have that I fund on my own life for my own retirement. I overfund it so I have extra cash at retirement. That's also the product that I referenced last time I was on with you, Mark, when I said I started my 18-year-old son with a product that he can contribute to, and me, mom, a little bit too, but we're going to contribute to that to help him build up a little nest egg that he can either save for retirement, but guess what? He's got a long time between now and retirement. So what about when he wants to buy a home and wants to have extra cash, or getting married and needs some extra cash? There's a lot more flexibility in that product. And then we have a survivorship, which is a second to die product, which is also designed as an IUL product. So let's go ahead and talk about some of the unique features. We've got in the IUL competitive performance. And so Mark mentioned earlier that the integrity in our illustrations, that we're not showing huge interest rates and a pie sky number that may not come true. Matter of fact, AG 49 has helped all carriers kind of bring that bring that cloud down a little bit. So, but we've got some features included in our design too to help limit that. So we're showing, even though our cap is 12.5%, we're illustrating a little bit over 7 as the highest. Of course, you can dial that down. Of course, performance could be better, it could be worse, but we're not showing the top 12.5% because that's not going to happen each and every year. But the average over the last 65 years, over 10,000 data points, does give us an average based on that at a little over 7%. Is that higher than they're getting in their savings accounts right now? Definitely. Variable interest rate loans. Well, these come into play when you want to access the money. So like I said, whether you want to take money out to buy a car, put it as a down payment on a house, for your own retirement income stream, variable interest rate loans allow you to access that money tax-free because it's a loan against the policy. And we have a cap on ours, which is at 6%. So even though me and my son are taking a policy now and funding it now, we don't know what the interest rate's going to be. And for him, 50 years from now, when he's trying to take money at retirement, that we don't know what the interest rates are going to be then, but we do know it's never going to be higher than 6 because that's our cap. We've locked that into the policy. It's contractual part of the policy. It's never going to be higher than that. So we can make an illustration based on that highest interest rate that he would be charged. But if we're also showing that he's going to potentially be earning 7% on the index performance, when you loan the money out and you're paying 6, but your money is still earning 7 for you based on index performance, that means even though he took $20,000 out to put down on a house, that $20,000 still earned him another 1% interest inside of the contract. It's still working for him even though he gave it to the bank. And that's the beauty of a variable interest rate loan in an IUL product. But the flip side could happen too. Maybe that's the year that the index has a loss of 0%, and they get the floor of 0%, but then we're charging 6% on the loan. So it could be the other way around, but hopefully it's not going to keep repeating itself year after year. So over time, it would likely be beneficial, but there are other loan options available, such as a fixed loan where it's a net cost of, I think it's 1.25%, or actually just withdrawing the money and not taking interest either way. But once you withdraw the money, then it can't work for you anymore inside of the policy when the index returns higher. There are accelerated death benefits that are included in the IUL product, just that you can accelerate for chronic and critical and terminal illness. The critical, if we're talking to anybody in Florida here, that I believe is not available in the Florida product yet. But those are automatically included as long as they get issued at the 80 or 75 is the max issue age for either of those two. And then as far as table ratings, we have to consider that too, that they might not be available. But those are included at no cost, and if they need to accelerate for chronic or terminal illness, there's a way for them to get to the death benefit even if there is no cash. But in an IUL policy, there's likely going to be cash at that time. So it's probably going to be more beneficial for them to just access the cash. Daily sweeps. What's different for North American there is that we use every trading day as a day to move money into the index option that the client chooses. Some companies only offer a monthly sweep or a quarterly sweep, and some even just an annual. So isn't it nice to know that when your client pays their premium today on September 6th, that we're using the September 6th value of their index option to start the measurement period. And rather than it sitting in a fixed interest account for another, 20 days or another 45 days if it's a quarterly sweep. I had mentioned earlier that we have several different index options, so the client can choose as many or just one if they want, and then they can make those changes potentially with each and every premium payment that they pay. So you could see that if they paid their premium this year, they can choose one index allocation and let that keep renewing in that one. And next year when they pay, they can maybe say, well, now I want this one to go to a different index option. Or like I said, when those 1 year segments expire, they could reallocate at that time. Now, if a client's paying monthly, potentially they could make a change every month. Probably unlikely, but at least they don't have to wait for the whole year. They could say, okay, I'm going to pay for or have it go to these index options for these next 6 months. And then they'll still have to wait for each 1 year segment to expire. But starting in the 7th month, I'm going to change it up a little bit so premiums from this point forward will be allocated as indicated. Let's go, the next one just are the two different IRS tests that can be used when designing an index product, guideline premium or cash value accumulation. I would just say, Messer Financial is probably going to be able to help you with that, but if you are running illustrations on your own, don't be misled that you want to choose the cash value accumulation test because you want more cash value to build up. That's not really how it works. If you are just looking for the best cash value performance, the guideline premium test is usually going to be your best bet in about 95% of the situations. Cash value accumulation test turns out better when you're trying to dump a lot of money in up front. So if you're just going regular annual payments or monthly payments, just stick with the guideline premium test when you're designing your illustration. North American does not require any money in the fixed account. But if the client does, I told you we could move it out at any time. But what do I mean by this, or what do other companies mean by this? Sometimes what they'll require is that the client will have to at least put money in the fixed account that will cover the monthly cost. So let's say the monthly COIs are $100 and the client's paying $150. So basically, they're going to make them put the first $100 into the fixed account to take care of the COIs, and then the other 50 is what's going to go to the index account. So now less of their money gets to actually take part in the index growth. But that's what you got to watch for. That's how some of the other carriers design their product. Instead, I think when I get, I don't know, maybe it's not on another slide, but what North American does is you put all the money we let you put it all into the index account, and then at the end of the 1 year segment, if there was a $500 payment in there after the premium load was taken out, we go back 1 year ago and we credit the 10% on the $500, not the $500 minus the next 12 months COIs. So we apply the crediting based on the beginning value in the index segment, not what's left after 12 months COIs come out. So that's the difference there. In competitive compensation, we have very nice target premiums on our IUL products for which your commissions are based, and our builder is one of the strongest, not only for you for compensation, but also for your client's cash value performance. A couple other things included overloan protection. That's pretty common in all IUL products. as far as, because we talk about building cash value that they're going to want to access later for their own spending needs or retirement. You want to make sure that the loan does not become larger than the cash value, and not knowing how it's going to perform in the future. So overloan protection is a safety net there. What's different for North American is we have a protected death benefit, and this lets the client actually say at some point in the future, you know what, of my entire death benefit, I want to protect 100 or 200 and make sure that my beneficiaries always get that, are guaranteed to get that paid out regardless of what I've taken out in loans. So it kind of lets them, works almost like a paid up portion of the policy at that time. So we'll just take whatever is needed from the cash value to pay that up at that point in time, and then let the rest perform on the index and let them access loans and such. North American does offer an interest rate bonus of 75 basis points beginning in year 11 on the builder and the guarantee builder, and then in year 16 on the rapid builder. So those are guaranteed interest rate bonuses, and those apply above the floor and above the cap. So in the example when I showed you 11% loss a few slides ago, if we were in year 11 or on, there would have been 11% loss, so we'd be at 0, and then we'd apply the interest rate bonus at that point. So there'd actually be 75 basis points that are actually credited that year, even though there was a loss, because that's a bonus that comes into play years 11 and on. And then likewise on the cap. So in the example we had where it returned 16, but the cap was 13, so we capped it out at 13, but if we're a year 11 and on, we're going to be able to add the 75 to that, so it'll be 13.75 is what would be credited. And then Simple Submit, this is our electronic e-application. This makes taking an application very easy through the Simple Submit link on the web. Just fill in the blanks as you go. It's this form, the form fields populate based on how you answer the questions, so that you can just fill it in, and it ensures that the application is in good order when it hits North American. As we just wrap up here, I just want to go to each of the products specifically, just to help you identify why you might, how do you choose which one of North American's IUL products to use for a specific client. So I had mentioned earlier that the builder is our strongest for cash value performance, and it also pays you the most for target premium. This is a product that both myself and my 18-year-old son have. This is the best product for building retirement income. It also offers low cost protection. So what my son has for his monthly cost on this product compared to what we're putting in, we are overfunding it considerably. So we don't have to get a term product. We can basically have it all in one and have the cash value build up right there. It can be great for 1035 exchanges. So rescuing another client's policy from a different, like a VUL, or showing them what growth can happen now compared to the UL they were in. So great for 1035 exchanges, and then even low face amounts. We can go down as low as a $25,000 face amount on this product, or much higher. The Guarantee Builder, this is the product I mentioned earlier. It would be the closest comparison that we have to a whole life product. So, and just GUL, guaranteed UL products, it's a really strong competitor to our custom guarantee, which is supposed to give you the lowest cost for a guaranteed death benefit without really cash value. But our Guarantee Builder sometimes even beats that product. So why not give them a guaranteed death benefit with the potential to build cash? And guess what? If the index does that bad and it doesn't grow, then at least we've still got their death benefit guaranteed. But if it does grow, you could actually extend that death benefit into something higher, or give them cash, so that not only can it be an exit strategy or money that they can access at retirement, or even growing the death benefit because it's growing so high. So this can be great for 1035 exchanges for rescuing other guaranteed products. It could reduce their costs, it could extend their guarantee period, and because it's an IUL product, it could grow cash value. Being that it's guaranteed, it's great for estate planning, and then the same low face amount here, 25,000 is the lowest we can go here. The rapid builder, this was the one I had mentioned earlier, builds cash more quickly. So early on, so early cash value growth, early access to that surrender value. There is an optional rider that can be elected to waive the normal 14-year surrender charge period. So less of it then is tied up in a surrender charge. We have a whole nother concept on smart money, which basically is a single premium dump into this product. We eliminate the surrender charge and we show them a better return than what they're getting in probably some other vehicle they left it, like a savings or a CD money market account getting a low interest rate. So this can have a great alternative for that smart money or unemployed assets that a client might have. And then business sales opportunities. This is a great product because of the waiver of surrender charge rider that can be on there, and it helps with the business owner being able to show cash values on their balance sheet. Survivorship was the last product. This was just one that insures 2 lives, so paying on the second death, and this also can be ideal for retirement planning, for business, family business continuation, and estate planning. It can keep the cost a little bit lower because the COIs are spread over the 2 lives because we only pay on 1. So be sure to consider that product as well. North American has a variety of sales concepts that go with our IUL products. Many of them are listed here, and all of the materials that go along with each one of these products are available on our microsite. I know that we've shared that before. I'll make sure to get that over to Mark. So if you do want to link to our microsite where you can access all of this and more on IUL, you know, to kind of go through and see some of the basic materials that we have for your clients too to help them understand. There's a nice piece on IUL that compares it to football season and the first down, second down, et cetera, and how basically you don't ever lose yards. That's kind of that floor, that protection. So it's a first down every time, and they never lose yards. So that's a nice piece that some of your clients might correlate with. So all of our concepts have materials for you and for the client, much of what they look like here. But really just going back to summarizing what we went through today, we talked about how IUL is really not all that different. It's just using an index account that we're measuring their growth over a period of time. We talked about some of the mechanics that make IUL different and how the index crediting actually works. And then briefly here at the end, I just mentioned a few of took you through our IUL products and why you might choose one over the other. Of course, anybody at Messer Financial can help you with that as well, in addition to myself. So with that, I do want to turn it back to Mark. I know I probably didn't give you much time to recap here, but I'll turn it back to you and we'll see if there's any questions that were entered into the question panel.
Again, thank you very much, Charlene. And you did just do a brief little recap. And I think the most important thing is that you presented in a very easily understood manner the concept of the indexed universal life product. And again, because some of you out there might be dipping into this for the first time, there still might be a little bit of confusion. However, the benefit of having the webinars actually recorded and then posted back up on the Messer website will allow you at your own time to go back and divulge into them step by step and pick up where you might have missed something. Or again, you can give us a call and we're certainly here to assist you in a better understanding. So again, first and foremost, Charlene, thank you for again bringing this to us in such a really easy to understand manner.
Well, you're very welcome, Mark, and thanks for inviting me back.
And ladies and gentlemen, again, the indexed UL product, you certainly are aware if you're in the market at all discussing life insurance with people, seems to be the hot button right now that's out there. So you do need to have it available in your ammunition. But if you're going to have the ammunition, it's like having a nuclear bomb. If you're going to have it, you better be prepared on understanding what it can do, what it can't do, and where you don't want to use it. And again, that's going to be your responsibility. You're the one that's going to go out there and talk to your clients. When you present them with the basics of life insurance and you protect them with a traditional term product in its simplicity, you do protect the family. But it's something that perhaps you can turn your back on for a year or two. Wouldn't suggest that. I still firmly believe you need to make that annual contact. But even more so, if you're going to get into the market of selling an indexed UL, you better be able to build your calendar and know that you want to get back to that client and do a policy review every year. So I thought with that in mind, Charlene, we might just touch upon when the client does receive that annual report, the detail that's going to be involved based on the mix of the selection that they have in their products. Could you just a little brief touch on it?
Yeah, thanks, Mark. Actually, we made a change here recently. So everything I just told you today about all of the index segments are 1 year. We do shorten the very first one just so that by the time the policy is funded, because the index segment doesn't start until we receive the money and place the policy in force. So if we issued it on September 1st, but we're not getting the money on the books until today, then the annual statement would generate for September 1st, but the index segment wouldn't be a year old until 5 days later. So what we've done is going forward, IUL products, that first year segment might be just 11 months or somewhere between 11 and the 12 months. So it's a little bit shorter so that we can show that index credit, because that was confusing for clients and agents, is that we just told them that they're, it's the watch for the growth, and then they get their first annual statement and there wasn't anything reflected. So we thought that it was beneficial to make that first segment just a little bit shorter so that it would be captured and portrayed on the first annual statement. So what you'll see is if it was an annual premium paid in the first month in September, then it shows month by month, October, November, December, and so on, the COIs coming out of the policy value. And then on the last month, then it's going to show if it was a 10% interest or whatever it was, then it's going to show the interest crediting. So it's kind of like a checking account balance is what I say is what you're going to see. You're going to see you made a deposit, and then you wrote some checks, and then the interest is credited at the end. So that's what you're going to see on the annual statement as far as the index growth being credited.
And when they receive that statement, they have a 30-day window to go ahead and make changes in the allocation?
To the index allocations?
Mm-hmm.
No, I don't think it's 30. It might be about 10 days.
Okay.
Or for the index segment that just renewed, or you could put in place, send in a form or make the phone call or whatever to change the index allocations for the payment that's made after that is in effect.
After it's in effect, okay.
Yeah, but I think you are right, though. There's about a 10-day window if they did want to reallocate.
Okay. So again, that's going to be the importance of the element of your scheduling that policy review with your clients when they receive that annual statement. And that's the best way to do it. I always tell my clients, when you get that, call me. And that way you know it's in their hands, so you're going there with the intention of taking a look at what they have. I think at this point, since we're already hitting the 10 o'clock hour, just a little quick future forecasting. Next week is the expo for Messer. So there will be no webinar on September 13th. And I will be taking off personally the 20th of September. So the next 2 weeks will be closed for webinar business. We're going to come back on the 27th of September, and we're going to do a webinar on the Medicare Advantage programs. knowing that we're going to be getting into that open season coming the 15th of October, and we're going to follow up on the 4th of October with information and a webinar on the traditional Medigap plans that have become available. So that's what you have in the future. Watch for your emails. And I think, again, sometime in the future, I have a difficulty scheduling as we get into this high-profile selling season, additional webinars to take you away from your business. But if we can find something that we feel is relevant and important, we'll bring it to you again. Charlene, once again, thank you very much for your professional and teachable ways of presenting information to our salespeople.
You are most welcome. Thank you.
And for all of you, I hope you have a great week. I hope we see many of you at the expo next week. And Mark Hunter, at this point, signing off. Thank you all.